Imagine being Sarah, a 22-year-old with $500 a month to invest. What would she do? Well, she has two options. The first one, she could attempt to pick the winning stocks. This would require her to spend her weekends engrossed in financial news, making purchases and sales based on headlines. Now let's consider the second option. She could do something that might seem a bit boring. She could set up an automatic investment and then completely forget about it. Fast forward to when Sarah is 52. With the first choice, Sarah could have $180,000. But with the second choice, Sarah could be looking at a whopping $1.1 million. It's the same money and the same 30 years, but one decision makes all the difference. So what does choice 2 look like? Let's break it down. Step 1 in the investment process involves deciding your asset allocation. This is essentially about how you divide your money across different types of investments. It's like putting together a pie, with each slice representing a different investment type. The size of each slice varies depending on your risk tolerance, investment horizon, and financial goals. Here's a simple, beginner-friendly approach to asset allocation. Consider putting 90% of your money in a broad stock market ETF, like VOO. This gives you exposure to a wide range of companies and sectors, helping spread out your risk. The remaining 10% can go into a bond ETF, like BND. Bonds provide a steady stream of income and act as a buffer during market downturns. So there you have it, your entire portfolio in 2 funds. It's that simple and almost free, with a total annual fee of just 0.04%. That's it for your portfolio. 2 funds, simple and almost free. Step 2 is about choosing the right account for your investments. If you're stateside, a Roth IRA is a strategic move. It lets your investment grow tax-free for life, maximizing your returns in the long run. Now, if you're tuning in from outside the US, a standard brokerage account is your best bet. It's simple, it's effective, and it gets the job done. One such example is Trading22. It's a reliable platform that handles investments smoothly, making your financial journey less of a bumpy ride. We've dropped a link in the description for easy access. Remember, the right account isn't just about where your money goes, it's about how your money grows. It's about the fees, the benefits, and the peace of mind. It's about laying a solid groundwork for your financial future. With the right account in place, it's time to automate. Step 3 is all about automating your investments. Imagine it's payday and before you even see it, $500 is whisked away into your investment account. It might sound scary, but it's a strategy that pays off big time. You see, you're not just investing money, you're investing discipline. It becomes a part of your routine, like brushing your teeth, and over time this can lead to significant growth. Picture this, 10 years of consistent investing with a 10% return, and you're looking at a cool $102,000. Double that time, and you're sitting on a hefty $382,000. But hold on, let's stretch this out to 30 years. Now you've got a staggering $1,130,000. Now that's how you build wealth, but be aware of these common mistakes. Despite the simplicity of this approach, many investors fall into certain traps. Let's delve into 3 common mistakes: over-diversification, stopping during a market crash, and waiting to have more money before starting to invest. First off, over-diversification. While it may seem like a smart move to spread your money across 15 different ETFs, it's not necessarily better than sticking with 2. If these funds track similar markets, you're just shelling out more in fees without gaining any additional exposure. Stick with a simple, cost-effective portfolio and avoid the temptation to overcomplicate things. Next, stopping during a market crash. It's human nature to panic when the market plummets, but remember, market crashes are essentially sales. Your $500 can buy more shares when prices are low, allowing you to gain more when the market rebounds. This is dollar cost averaging at its finest. So, instead of hitting the brakes during a downturn, keep your foot on the gas and take advantage of those discounted prices. Lastly, waiting to have more money before starting to invest. It's a common misconception that you need a hefty sum to start investing, but the truth is, the best portfolio is the one you actually start. Even if you can only spare $100 a month right now, it's better to start today than to wait until you can invest $1,000 a month in 5 years. Remember, the power of compounding works best the longer you let it run. To avoid these pitfalls, keep your portfolio simple, continue investing regardless of market conditions, and start investing as soon as you can, even if the amount seems insignificant. Avoid these mistakes and you're on your way to a solid financial future. Now it's time to act. Open your Trading212 account, buy 1 share of VOO, and set up your monthly automatic investment. No matter how small, start your investment journey today. Don't delay, thinking you need to wait until you have enough money. Remember, $100 invested today far outperforms $1,000 invested 5 years from now. This is the power of compound interest working in your favor. The beauty of this approach is its simplicity and its automation. You don't need to be a finance whiz, nor do you need to constantly monitor the markets. The system works silently in the background, growing your wealth while you focus on living your life. You have the power to build wealth, 1 month at a time. If Sarah can build $1 million portfolio with just $500 a month, what's stopping you? Share your monthly investment amount in the comments, and remember to subscribe for more finance videos every Monday.